Good morning, everyone. Welcome to this update for global stocks and commodities for the 27th of August. There really are some wonderful opportunities emerging in what is a period of uncertainty, but that's pretty normal for August and September. But look, really, if you know where to look and how to play them, there's terrific opportunities out there. So I want to just point to some of those in today's video. So in this update, I'm going to be looking at the basis of how I analyse technically. Haven't really provided a huge amount of detail on that in the past, but I think just some of the core principles. I'm going to be looking at what the price action is telling us, looking at a whole range of global stock indices, in particular the Nasdaq, which has been providing leadership to the American market and therefore the global market for several years. The all-important US dollar is really at a critical level at the moment. So just from in general terms, the most profitable approach that you can take either as an investor or as a trader is to have an awareness of what the fundamental analysis is telling you, understand the difference between good companies and lesser companies, understand valuations, because if you're fundamentally riding a good horse, then any short-term disruption to the price or to the market is generally going to be recovered very quickly. So it does improve your odds of success dramatically. So fundamental analysis is critical, but even more critical is technical analysis. If you're not using technical analysis, I just don't think you're playing a game with one hand tied behind your back. So I just want to cover some of the basic elements of my technical analysis. It goes a lot deeper than this, but I find in talking to people over the years that sometimes they just get too involved in technical analysis and they rely too much on technical indicators that most of them are just lagging indicators. They're just really a graphical representation of what has been. And the unfortunate thing is that a lot of people look at them in a way that is an indication of the future, and most of the time that's not so. So these are the basics just to bear in mind, and technical analysis really can be quite a straightforward exercise. So when demand exceeds supply, so when more people want to buy stocks than people are willing to sell, then prices move to a higher level of equilibrium, and that level might take weeks, months, or even years to reach. Of course, on the other side of the coin, when demand is less than supply, then prices move lower. And, there's nothing more tricky about what causes prices to go up and down than that. It's just basic laws of supply and demand. And the analysis of price and volume patterns highlights when these are imbalances that have built up start to adjust. And if you become accomplished at reading price and volume patterns, then you can anticipate moves basically before they start, and certainly once you've got confirmation, then you can participate in those movements with a much greater level of confidence. And the final thing is that the wider the period of congestion, so whether it's accumulation after a bear market or whether it's distribution after a bull market, then the greater the breakout move is going to be. So that's a really important one, because a lot of people start to doubt when a stock has moved a certain distance, they start to worry that it's not going to continue. And oftentimes the really strong trends will go a lot further and a lot longer than what anyone anticipates. So just some key basics on technical analysis. Now, last week we launched a new service, and I just wanted to give you a little bit more specific detail about what you could look to get from that service. It's really about knowing with a great deal of confidence which way a stock is most likely to go, and I think that's really the key benefit that I want to convey through this service. Identifying low risk entry points, and there are multiple entry points generally when a stock is in the process of breaking out and embarking on a new bull market. And most importantly, and this is the hardest one that most people struggle with, is where to take profit and how to take profit. It's really the most challenging thing that traders face. I'll be obviously looking to uncover stocks when the moves are just starting. I mean, I'm sure most of you have got onto stocks when the move has been in progress for a long period of time, and therefore may be close to ending. But with the technical analysis that I'll be going through, you'll be able to discover stocks when the moves are really just getting going. And in this week's particular approach, I'm going to be placing a lot of focus on China, which is really the strongest sector on the planet at the moment. There's no question about that. Some of the stocks have already been running hard for some time, but there are many that are just emerging now. And of course, the main thrust of this new service will be analysing questions from the group. It's just $19 a week. On a monthly basis. So, why not come and try it for a month or two? I think you'll like it a lot because you'll learn a lot, and it'll be quite profitable for you, I'm sure. So a very exciting period as I see it in the market at the moment. Now, there will be a link to join on this video, and there'll also be a link in the description below. So let's get on with it. The global perspective. Context is essential. If you've ever spoken to me personally, you know that that's the first thing that I go to. There's no point in looking at individual stocks or sectors unless you're looking at it through the lens of the global context, which is what I spend an enormous amount of time sorting out. And without it, I think just any stock decision on its own is just about worthless because you can only do things in the context of the broader market. Global economic growth is improving. There's no question about that. And this is the most important tailwind for stocks. So you can read all the theories and projections you like from all the people out there that are trying to call a top to the market. But the most important tailwind for stocks is global growth. And we're seeing global growth on a synchronized manner around the world. Europe, even Japan, is certainly picking up. China's getting through okay, and the US is not spectacular, but it's good enough. So with that in place, what else should you be considering at a global level? Well, one of the key ones is sentiment exuberant, because that's how market tops get born. And there's been no exuberance in this rally since 2009, none whatsoever. And in fact, the level of enthusiasm for the market is in fact waning. Now, the bears that want to call the top and tell you that there's looming gloom and doom, they will seize on that waning enthusiasm for the market and say, well, there's the proof that we're at a top. But in fact, it's exactly the opposite. That is proof that we have not reached anywhere near a top. And because exuberance takes quite a while to build, because it's a psychology thing, it takes a long time to build up. I'm confident that we're nowhere near a major top in the market. The next thing are price patterns changing character, and that's one of the things that I spend a great deal of time on, and particularly when I look at the indices through this service. I'm going to have a good solid look at the Nasdaq because that's been providing global leadership. And if the price patterns are indicating a change of character, then to what? Is it merely an extended pause period, and the uptrend, the big picture uptrend, will resume, or is it into a period of a bear market? And that's really the key. Just because price patterns are changing character doesn't mean they're changing character to something negative. So looking at American stocks now, what is the state of play for the indices? Look, if we got a mild leg lower, we've already had a little bit of a dip, but certainly markets stabilised very quickly. But if we did get a mild leg lower, it would hardly be unexpected. We've had such an incredible run that you've just got to give the market an opportunity to take a breather. So if we got a 5 or 6% down move, then don't panic about it. I know it would be probably a little bit more challenging because we haven't had one of those for several years. So it's going to be harder to live with. But it's hardly unexpected, and it's hardly a signal that that things are coming off the rails. The Nasdaq is still providing leadership, as you will see, and the Russell, which did negate its breakout, which was disappointing, but it's now found some support and is rebounding to a degree. So we'll look at those indices. Now, I'll also want to take a good look at the US dollar because it's absolutely critical. It impacts every asset class, stocks, bonds, commodities, everything. It impacts global trade. It impacts inflation. It's just everything. So it's critical to look at the US dollar. And it's at the moment it's threatening to break support, very important support. So this is a pretty critical time for the US dollar. The S&P ended up 18 points higher for the week, so a bit of a mild rebound. And largely the market is ignoring Washington. A lot of people are really looking at Washington and looking at North Korea and saying, well, surely these have got to be triggers that are going to bring the market down. But the market's just ignoring what's going on. And the reason is that it's largely irrelevant to the smart money players, the big players, the big hedge funds, the really smart operators in the market. They're running major campaigns. They're in it for the long haul, and they're not put off by what's happening in Washington at the moment. They're the ones that are looking at the global economy. They're looking at the facts of what sustains bull markets, and they're not being put off by that at all. So let's jump in and look at some indices. This is the S&P. I've left these zones of potential support here from last week. Obviously, this area around 2400 to 2415 is important. We didn't quite get to it, and we've rebounded. And we've rebounded almost to the halfway level of this particular range. So at this point in time, I really can't discern anything much from the S&P. There's just not enough information. At the moment, we've formed a higher low. We don't have a higher high, and frankly, I don't expect one for a little bit of time yet. So we might just meander along, and at the moment, the market is not giving us any guide. There's a larger support area down here, but that's really not in play at the moment. Now, turning to the Nasdaq, and this is a weekly chart of the Nasdaq that I've had structured up for quite a few weeks now. You can see we had a trend channel in progress up until here, and then we busted out of that trend channel in February of this year. And then we've continued to advance at a high level. We created a higher rate of ascent through here, and we haven't violated that one yet either. So that would be the first thing. We'd need to violate this particular rate of ascent, and then we would need to come back down into this channel here. And really, a sign of real weakness in the Nasdaq, we'd really need to break this level here. And that's a long, long way below where we are at the moment. So the Nasdaq is not giving any sign at the moment at a big picture level of interrupting this big picture trend. And because this is weekly, then we go back to 2012 here on the left-hand side of the chart. But look, to zero in on this a little bit closer, and also to get volume. So this is the QQQ, which is the ETF covering the Nasdaq, and it's also on a daily chart. So the things to note here are that we have had a change of character. So all through here, we had very little in the way of sharp down days. We got one here and we got one here, but they were single days. Now up here was the first time we really started to see a change in character. That was the 9th of June. You can see that we got a much bigger candle, and it occurred on big volume. Look at the volume around this particular peak. We only went down for a day or so. We went back up again, and we formed a lower high. And that then started an ABC correction. So here's the A leg, here's the B leg, and then down into the C leg. This is a pretty, classic sort of mini correction pattern. We had substantial volume on the first decline. We then got a weak rally. You can see the volume dropping right away very quickly on the rally. So that was a pretty weak rally, indicating that the market would go lower. Then the volume spiked right up again on the decline. So the volume really going up on the decline. So that's all pretty negative at that point in time. However, we've managed to find support at the prior low. So we didn't go down and formed a lower low from the last time there was a bit of selling. We then went up again, not on particularly spectacular volume. You can see the volume through here is reasonably modest. So we managed to go up and form a new high on fairly modest volume. We then got another big candle up here on the 27th of July, and look at the volume. So this is the big players selling. They're taking profit, and they're doing it fairly enthusiastically. So throughout this period, we saw more volume spikes on the down days, which is indicating active selling. So look at them all. Look at all these red spikes on the down days. So all of this is potentially negative, but I say potentially negative because the price is the other important part of the equation. So these big volume spikes certainly cause me cause for concern. However, price has not broken down yet. So the possible outcomes of all of this, which is still unresolved, are that we get a reaccumulation range. So we get a range that looks like this, and it goes on for a period of a few weeks or a few months, and then the uptrend is resumed. So that's one possibility. The second possibility that we get, I'll deal with this one first. We get a decline within the overall uptrend, and we come down to the 200-day moving average. So we get a pattern that looks like this. So a little bit deeper, and because it's a little bit deeper, it'll probably go on for a bit longer. So that's the second alternative. The third alternative is that we get a breakdown into a bear market. Now, at the moment, there's no real sign of that. This volume spike here, this is not supportive of a bigger picture decline. So that one I would assign a very low probability at this point in time. I think the highest probability is a reaccumulation range, so that we're looking here. I think that's the highest probability. Come down a bit deeper is the next possibility, and that's probably about the only scenarios that I think are in play at the moment. Now, the reason I'm spending so much time on the Nasdaq is because it's been providing leadership to the whole market for a long period of time. So let's just pan back. The Nasdaq has been on an absolute tear since this goes back to 2009. It's been providing leadership, and I'll just show you a relative comparison chart between the Nasdaq and the S&P. So this goes back 5 years and starts from a common point. So it's the S&P in blue and the Nasdaq in green. You can see that through 2012 through to 2014, the S&P was a little bit stronger than the Nasdaq, but then the Nasdaq started to outperform. So the green line is above the blue line, and that particularly started to accelerate in July of 2016. So a bit over a year ago, the Nasdaq started outperforming the S&P quite dramatically. It's been providing the leadership that has continued to keep markets going all around the world. So a breakdown in the Nasdaq is not a good sign, and that's why I'm placing a fair bit of emphasis on the Nasdaq. But let's just come in a little bit closer and have a look at this last little period, because that's quite a big picture view. So let's come in and look at the last year. So there's the last 12 months, and you can see that we had this wobble here in January and in June and July, but very quickly the Nasdaq regained leadership. Now let's come in a little bit closer again and just look at the last quarter. So let's just tighten this view up. And you can see that really it's been pretty much line ball. Here's the period where the Nasdaq underperformed, but it's very quickly regained that and has been performing roughly in line with the S&P. So a lot to learn from the Nasdaq. Let's take a look at the Russell 2000. This is the daily chart, and I've posed this question: what would what would signal a breakdown of this pattern? Now, when I first constructed this, we were above this really steep trend line, and it looked like we had a breakout. In fact, we did have a breakout, but it turned out to be a false breakout. We came down below this level. We then came down below this support level, and we came down and we even broke this original support level. So quite a decent breakdown in the Russell, and that's another one that I'm watching. We didn't get down all the way down to this level, and we have started a rebound. Now, there's really not enough time. I'll do this next week, but I want to look at the Russell, look at the ETF, so that we can bring into play the volume patterns around this as well, in the same way that I did with the QQQ. So look for that analysis next week. Now, the US dollar. This is the chart we've been looking at for some time. Critical level here. As you can see, we can get little overruns, which we got in May of 2016. So far, the bounce has been very weak. It's hardly got any momentum at all. And we're back down on Friday at dangerous levels. This is looking pretty critical to me, and I suspect that we're more likely to break down than to rally from here. But again, let's look at an ETF, which gives us volume. So the ETF for the US dollar is UUP. And let's put some structure around this. Now, this is on a weekly chart, just to compile a bit more information. So let's put some structure here. So we had a higher high, and we've also got some lower lows as well. So we've got this broadening megaphone pattern that's developed on the US dollar. Now, we've also got, of course, this key support level across here, as we saw from the previous chart, which we're sitting right on at the moment. Now, the things to note, a big volume rise into the peak. So this peak that formed up here in December of last year, look at the volume that really picked up on that rise. And even back here, that volume had really started to kick up. So a big volume rise into those peaks. And then, of course, it rolled over and the volume was sustained on the run down. And we find ourselves now at this level. Now, the volume has been declining to a degree, and we are oversold. So we're well and truly overdue for a bounce. That bounce hasn't occurred yet. It's possible we could get a little break of this low and stay within this megaphone pattern and move just a little bit lower. So UUP is currently at 23.99. It's possible we could come down to about 23.67 and then bounce from there. But if that breaks, then that's really serious, and that would have a massive effect on global assets. So that's another one that I'm going to be watching extremely closely. Now let's look at some of the other global indices that are important. This is a German DAX. Nothing dramatic there, as you can see. A little bit of a decline, but it's stabilized pretty quickly. This is the FTSE in London. No real breakdown there at all. That remains extremely positive and at all-time highs. So no concerns there. Let's look at China. China, really interesting. This was a big pattern that had started forming back in January of 2016. So this has been running now for about 20 months. A key resistance level that we broke above in August. And we've come back, we've done a retest, and now we've shot off again. And look at the action on Friday night in China. And that's why I'm going to be really putting a focus on China in this week's Q&A session. So if you if you want to get on board, this is live. This is happening right now. Huge support going into those Chinese stocks that are listed in America. So that's a really important move in that index. And finally, let's look at the Nikkei in Japan. So let's take a big slice of action on Japan. This is the peak in 1989, up at nearly 40,000 points. You can see we're still half that nearly 3 decades later. That's how much of a bubble that was in Japan. But you can see of late, since 2012, that the market in Japan has been pretty positive. So we've definitely got an uptrend there on really all time frames. So on a longer picture time frame, we've got an uptrend. Let's zero in on a shorter period of time from June last year, and we've still got a strong uptrend there. So I don't know how people can, with a straight face, say that they're calling a market top at the moment, because there are just so many positives out there. It's not funny. Okay. Pardon me. Let's move on to the Australian market. The Aussie dollar was up a little bit, and that's really reflecting the US dollar falling on Friday. The index was lower by 4 points on the week. There are a few local gems in Australia, but Australia's just so much harder work than America. It's chalk and cheese. You've got to be very selective, and you've got to be very patient. But if you are both those things, then we've been able to grab a hold of some pretty good ones, I must say. Precious metals, gold was higher by $5 to $12.92, so still unable to break above the 1300. Positioning in the futures market, though, favours short-term downside. The number of longs on the futures contracts has risen significantly, and the number of shorts has plummeted to the lowest position in 5 years. So the bullish positioning in the gold market in the futures market is quite strong, and that is always a contrarian. You should look at that from a contrarian point of view. When it starts to get to those sort of levels, you don't want to be jumping on that train. So I would just be careful in the sector at the moment. Key horizontal support and resistances are still in place. Gold holdings in the ETFs picked up to 805, so that's improving, which is good to see. But physical demand for gold in Asia is still weak. So that's not a particularly good sign. People there are waiting for gold prices to come back again. And precious metal stocks are improving slightly, but there's just no momentum in that sector at the moment. So let's take a look at that. Let's look first of all at gold. This is gold on a daily basis. So we had a little peak above the 1300 level last Thursday of the week before. But we've been unable to push up. But then again, we haven't pushed down either. So that's the other side of that coin. And if we look at the relativity to the long-term downtrend, we've been able to break this big long-term downtrend line. So at least that's a positive. We just haven't confirmed the breakout yet, and it's possible that we could move a little bit lower and perhaps track this trend line down a little bit. Looking at GDX on a weekly chart, you can see not a lot of change there. And these are the things we're looking to see, and we're not seeing any of those things at the moment. So we're still on a wait and watch mission for the Australian market. For the gold market. Turning now to other commodities, copper has moved very strongly up to 301. It's partly currency, but there's certainly some buying in copper and nickel in particular. Crude oil was steady around 48, but stock's still not responding, so not a lot of joy there. There's the copper chart. It's really moved up very strongly from 260 to be above $3. Is crude oil, no real change over the week. So wrapping it all up, how to play this period of uncertainty. So we've got uncertainty in the Nasdaq, the Russell, and the S&P. There's nothing definitive there yet, but certainly a period where you need to be a little bit more cautious. Look, overwhelmingly, just let the price action be your guide. I get emails from people that want to predict things, or they want to try and anticipate things, or jump out of the market out of some sort of misguided fear. Just don't do that. Just let the price action be your guide, and you're not going to get caught out by the market suddenly falling apart. It just doesn't happen that way. I don't know where that predisposition started from, but significant downturns in the market are always preceded by significant volatility and a series of peaks and troughs that make it easy to get out at much better, more opportune times. So, don't do anything drastic until the price action actually tells you it's time to do it. I expect sector strengths and rotations to continue. That's what happens during these sort of periods. But look, overwhelmingly, I'm excited. Some stocks are doing fabulously well, and more are just breaking out of some really, really promising patterns. They're some of the most productive patterns I've seen in a long time. So, I'm as enthused about the market as I ever have been. I think we're in a terrific period. So that's it for this week. A lengthy one, but a lot to cover. There's my contact details. And if you are interested in this new service, which I think really meets the needs of a lot of people, as I've been hearing it, then you will see opportunities to register for that. So until next week, cheers.